All year long, we've been discussing this scenario where the Bitcoin price grows way faster than mining difficulty. And over the past month, this is exactly what's played out. We've seen Bitcoin price go up almost 40%, while during the same time, mining difficulty is only up about 10%. Danny, assuming our listeners are unfamiliar with this concept, can you simply explain what this means and why this is so great for Bitcoin miners?
Yeah, absolutely. And Mitch, you and I spoke about this exact topic. I want to say it was the beginning of the summer, right? We were hypothesizing what could and very likely, may happen. And the concept here is that it's a matter of velocity. So if you think about Bitcoin mining economics, you've got a numerator and a denominator. You want Bitcoin price to increase, and you want Bitcoin price to increase faster than difficulty, meaning hash rate on the network. When that happens, hash price increases and mining economics improve. The profit margins improve, right? So just to rehash a little bit, when we spoke before, we said, this is a velocity game. Bitcoin price can move significantly faster from a velocity perspective than difficulty can move based on real world logic. So let's look first at Bitcoin price. In the last 3 weeks, we had a a new president elect become elected. The net of it, to fast forward a little bit, is we have seen significant Bitcoin price appreciation based off of what are effectively news items. Right, a new president was elected, a new regime is coming in. We've seen, MicroStrategy just today announced that they slam bought a significant amount of incremental Bitcoin for their balance sheet. We've seen other companies start to copy this and increase their velocity of Bitcoin accumulation as well. When these things happen, they can happen quick. Buying Bitcoin can happen very, very, very quickly, right? And that's what's happening right now. Why we're seeing such a high velocity increase in the price of Bitcoin. Now, if you look at the difficulty side of the equation here, in order for Bitcoin or for difficulty for hash rate on the network to move at a pace that's equal or greater than the velocity of Bitcoin, a tremendous amount of real world developments need to take place, right? You need to have hundreds of millions of dollars of infrastructure, land, energy. ASICs need to get to their home destination, be plugged in, so on and so forth. Those things take time. It's practically impossible for the velocity of difficulty to keep up with the possible velocity of Bitcoin appreciation. And that's what we're seeing right now. Right. Blake, I'd love to hear your thoughts on this too, just more from like, what are the impacts from a little bit more of a quantitative perspective? I'm giving some qualitative, real world examples, but how is this playing out, now?
Yeah, definitely. And I have this conversation all the time, right? The question of how does the difficulty adjustment or how does Bitcoin price action directly impact me as a miner in my profitability and my economics is a very common question, and it's something that can be definitely hard to wrap your head around at first, right? There's a ton of different inputs, but when we take a step back, like what are the outputs? What does it actually look for me like as a miner? Um, the result of this kind of environment that we've been in for the last, I mean, only a few weeks, but I think it's going to exponentially increase from here. Is that, to Danny's point, and to your, the way you phrase your question, Mitch, price is outpacing difficulty right now. So what that means in Danny's example, there's a numerator and there's a denominator. When the numerator, which is effectively price, is increasing faster than the denominator, that number at the end is called hash price is increasing. So that means you're earning more revenue. The way that you can look at it as an individual is like the way I like to look at mining from an economic perspective a lot of times is just like, what's my like break even point, right? So it's looking at how much Bitcoin did I mine in a given month, and then how much did it cost me in electricity. If you divide BTC by cost, it gives you a number that's saying I effectively, could have mined, depending on scale, one Bitcoin for, 40,000, 50,000, 100,000. It all depends on the efficiency of your machines. But as hash price is increasing here, this kind of arbitrage, because you have a break even point, right? For a S21 XP right now at a 7.8 cent rate, it's somewhere around $40,000. So you could go and you could spend $40,000 at Coinbase or, Gemini or whatever, and you could acquire one Bitcoin, or you could acquire, less than half of a Bitcoin, or you could spend $40,000 in electricity with those specific machines at that electrical rate and mine one Bitcoin, right? So mining is effectively an arbitrage on a few different fronts, but the way I look at it is, what am I spending? What's my effective, buy price, if you will? And then what's the, spot market actually at? So, modern next gen ASICs, primarily the S21 series from Bitmain, are for the most part producing Bitcoin at a, 40, 50, 60% discount to the spot market. So when clients ask me a lot of time, like or prospective clients, if they're brand new to mining, never really gone down this, rabbit hole within a rabbit hole before, is like, what is mining? It's just a more capital efficient way of accumulating as much Bitcoin as physically possible over the long term. And the way that works is you're acquiring that Bitcoin at a material discount to what you could otherwise buy it at, on the spot market. So to simply answer the question, what does this look like for, the individual miner, the institutional miner, whatever, as hash price is growing and prices outpacing difficulty, it just means that your arbitrage, on that daily consistent DCA basis is growing, and you're acquiring more Bitcoin relative to your monthly cost.
Yeah, that was really well said, guys. And to kind of just illustrate where we actually saw this play out is over the last month, right? Bitcoin, the price, I like to say it can like teleport in a way, right? Because we went immediately from 80,000 per Bitcoin to 90,000. We just jumped through that entire range. And for those who are kind of relatively new to financial markets, or just a refresher, price is set at the margin, right? And this is how this is able to happen. Because if there's no more sellers at 80K and you have demand coming into the market, there might not be any sellers at 81, 82, 85, right? And it's not until 90K. So the market has to find that next point of marginal supply. And who knows where that is after 90K, right? We're kind of trading range bound around 90K, but there might not be any sellers at 95 or 100 or 110. So the Bitcoin price can just jump. And this is exactly what we've seen in 2024. I mean, back in January, February, we went from 40K basically to 65, traded at 65 for a while, and then we basically went from 65 to 90. So if you're not in the market during those big crucial jumps, you're going to miss out on a lot of the gains that Bitcoin can make. And as a miner, that's where that spread between the cost to produce it and the actual Bitcoin price is the greatest, and you want to be online during that. So we'll jump to the next question here. And, obviously the talk of the town in Bitcoin over the last month has been the strategic reserve, right? You've got the Trump calling for it. We're going to stack Bitcoin as a strategic reserve asset for the United States. You've seen individual states like Florida and Pennsylvania do the same thing. And this is creating this game theory effect. Well, now other countries are going to start accumulating their own strategic Bitcoin reserve because they don't want America to get theirs, having a great impact on the price. But if you take this concept to the next logical step, it's going to be nation states mining Bitcoin. And this is something, there's been rumors circulating for years that some countries are already doing this. I think those are very credible. What effect would this have on individual miners? Like, how should they be worried that nation states are going to start mining Bitcoin and this may cause difficulty to go way, way up?
Yeah, for sure. The strategic reserve, right, is kind of the overarching, thesis or story that's kind of driving for the most part, the market cycle at, this very moment in the short term. And we're also seeing it on the, corporate side of the ball too, right? In today's November 18th, the news today is Marathon is trying to, issue debt to buy more Bitcoin, and MicroStrategy just bought billions of dollars worth more Bitcoin. So we're kind of getting this space race on the corporation side, on the corporate side, to accumulate as much Bitcoin as possible. And then, theoretically, we should see this, happen on the kind of nation state level too. The way I look at this is just there's only so much supply of Bitcoin available, especially when you start to look at like OTC desks and like what exchanges have on hand as well. there's not that much supply available. And the beauty of Bitcoin's design is that there will only be so much supply available ever. So obviously the thought here is with this exponential growth in demand and a fixed amount of supply, that price has to increase to accommodate this. And then this goes back to the point that we were just discussing with hash price, right? When the numerator in that equation is going up, right? The price of Bitcoin is increasing. The value of that daily block reward, or per block reward, is going up exponentially. Then miners are the ones who are going to benefit from that. You're also going to see a lot more activity on chain, right? When you have all of these massive entities trying to accumulate Bitcoin, you have retail investors trying to accumulate Bitcoin, you have ordinals projects and other kind of on-chain activity. Transaction fees are going to spike or just should be relatively elevated in this point of the market cycle. That also increases the numerator of that hash price equation, if you will. So I see these as good things for miners, right? And Mitch, to your point, we saw this massive spike in Bitcoin price over the last couple of weeks or so, or really couple of months almost. And it's all about like time in the market versus timing the market, right? And people talk about that in a lot of different contexts, but specifically for miners is like, Bitcoin has these runs every few years, but there's really like a handful of months within those runs where a lot of the gains are made, right? And it's really hard to time the market if you're a trader or an investor. But for a Bitcoin miner, generally you have a longer term time horizon, right? You're kind of the idea with mining is effectively like delayed gratification, right? I'm going to deploy capital and I'm going to purchase hardware that's going to, over the long term, accumulate more Satoshis than what I could otherwise buy by spending my whatever $1 million today on just buying sats from Coinbase, right? So when you're have all this time in the market and you're accumulating a lot of Satoshis at varying price points, at varying hash price points, you really set yourself up to be as successful as possible, right? And now that we're kind of in this broader super cycle, if you will, with this space race to accumulate as much Bitcoin as possible, miners are going to be the ones who are going to benefit this over the long term for the most part, just because they're, to the point earlier, accumulating Bitcoin in the most capital efficient means that they possibly can over the long term. So if you're someone who's bullish on Bitcoin over the long term and you want to accumulate as much as possible for retirement or for your kids or to whatever, buy a house, you want to be as efficient as possible when you're deploying your capital, and that's kind of what the name of the game is with mining.
Yeah. I'll add just a little bit to that because I think a lot of, that question was also focused on incremental large entrance into mining, right? So I think the concept, I like to think about this as really like a rising tide raises all ships, right? So what do I mean there? Blake just unpacked it perfectly, but just to briefly reiterate, uh, we're seeing right now the very early stages of the game theory that we've been talking about for years and years starting to play out. We have a pro Bitcoin, you know, presidential regime in the United States. We have states introducing Bitcoin strategic reserve legislature, for example, Pennsylvania, which we just saw. We have more and more corporations buying more and more Bitcoin for their balance sheet, and largely because everybody in capital markets can see what that has done for example, MicroStrategy's stock over this last, four, a little over, probably about 4 years, right? So the velocity, again, that velocity happens very, very, very quickly. Really, really awesome for miners because, again, Bitcoin price can move significantly faster than uh, difficulty, then hash rate can come onto the network, right? But when you see these spreads get exceptionally juicy, like what you're seeing right now, it does provide an economic incentive for uh, more miners to enter the game, so to speak. Because the if I'm arbitraging Bitcoin at 40, 50, 60%, that's like the best dividend paying asset that traditional financial markets have ever seen, right? It's not rocket science. It's like, this is awesome. I'm going to get a piece of that. That theoretically makes Bitcoin that will lower hash price on a, because you get more, um, you have more miners, you have more, the difficulty will increase. But you get kind of this flywheel effect then, because what happens when more miners come into the network? The network gets stronger. What happens when more participants are, buying Bitcoin or leveraging the blockchain? Transaction fees go up, right? So I think, back to my thesis of, or my, statement of a rising tide raises all ships. This is good. Like, if Bitcoin price goes up 100, 200, 300%, first of all, no matter how many nation states come to the table, it's still virtually impossible to keep up with that type of velocity because of the real world restrictions. But you're getting so much more eyes on Bitcoin. You're getting so many more use cases of the Bitcoin blockchain, right? And all these economics are, all of these rewards are basically spread to all, the variety of participants, and the product, if you will, the network gets stronger. And ultimately, a strong foundation makes Bitcoin, it is very, 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 very good for Bitcoin over the long run. And it happens to coincide with, significant returns for participants, right? So I think it's something to watch. But right now, especially, we're in a massive, Bitcoin price velocity exceeding, incremental hash rate velocity type environment, which is exceptionally bullish for miners. Let's say one more thing real quick is what you then see happen as you have more demand for mining. Uh, Hardware, machine prices cost more because there's not an unlimited supply of ASICs as well, right? So there's trickle effects for anybody who's positioned, at or in advance of these massive runs are the folks who win the greatest.
Yeah, I really agree with a lot of what you guys said there. You brought up the point about hardware, and both of you guys are on the front line when it comes to Bitcoin mining hardware. Are you starting to see prices go up now over the last month with Bitcoin just on an absolute ripper?
I'll start this one off. Not drastically, not on like a mark to market basis kind of thing, right? We will, right? And maybe a little history is helpful for this one. So if we go back to last cycle, right? And we've talked about this a lot, on a variety of podcasts over the years, but especially in, let's say, Q4, Q3, Q4 2021, that's when we started to see ASIC prices increase significantly. There were basically two catalysts for that. One, significant increase in Bitcoin over a smallish period of time. So the mining economics became exceptionally enticing, which brings more entrants, into the picture, and more entrants on a, not fixed supply, or sorry, a relatively fixed supply of ASICs makes the ASICs cost more, right? There was one too that is interesting, and I kind of characterize this as like a ASIC supply squeeze of sort. And on one hand, that'll happen because you have incremental organic demand for ASICs because, again, those mining economics are so enticing. We also had a bit of a black swan scenario in the last cycle wherein, um, COVID supply chains were very tight. A lot of these machines come from China, which had very, a lot of supply chain disruptions at that time. So that compounded that squeeze. And we saw ASICs increase, about 6 times from throughout the cycle, right? They cost about $20 per terahash at the beginning, and they topped at about 120 terahash. Right now, we're still in the like $20 to $30 per terahash price range. So I think, we're starting to see prices increase a little bit, but Bitcoin is up, what, 40+% over the last few weeks, and we're not seeing 40% price increases in ASICs yet. which I see as an opportunity because ASIC prices lag the market a little bit. One, it just takes people a little time to wake up. People got to remember, like, what is Bitcoin mining? Oh, I can actually access Bitcoin mining, relatively easily with companies like Blockware, for example. All right, so there's some natural laggard effects that I think are playing out. So again, net is right now is like the sweet spot, right? Bitcoin's up 40%, machine prices are up 5 to 10%. I've got a 35% hardware arbitrage now if I'm looking at that on a one-to-one basis, which is opportunistic.
Right. And if Bitcoin is your barometer, like your opportunity cost in terms of just buying Bitcoin went way down because the Bitcoin price is up. So if you save in Bitcoin, your purchasing power is way up, and we haven't seen the machine prices sort of rebound yet. Blake, do you have any thoughts on this idea?
Yeah, I don't have a ton to add beyond what Danny said. I think he kind of hit the nail on the head. Rig prices have started to increase, but the rate at which they're increasing hasn't, really matched up to Bitcoin quite yet. What we've seen historically, to Danny's point, is machine prices do have a positive beta to Bitcoin, right? There is a positive correlation there, but there's a lag, right? For a number of reasons, like Danny just pointed out. I think like an interesting way to look at this is look at pricing on the Blockware Marketplace, right? You have a set amount of supply on there. There are more machines coming online constantly, but suppliers or sellers on our platform don't often like increase their pricing based off of the market every single day, unless they've denominated their sell price in Bitcoin. But the vast majority denominate pricing in USD, and then they leave their offer up there, right, until there's a buyer, right, until someone comes up and meets that offer or bids and they accept it. So we need demand to chew through that supply for the most part until we're going to see prices increase, at least on our platform. And I think it's kind of a very similar situation to what we're seeing from like the OEMs, right, like Bitmain and MicroBT, and then also what we see in like the secondary market, right? You have a fixed amount of supply out there. They have a certain cost basis on that hardware, but now that supply is starting to dwindle, right? We talk to secondary suppliers and OEMs all the time, and what we're seeing is like supply, especially US based supply, is starting to dwindle. So you have this period where there is a positive beta, a positive correlation between rig prices and Bitcoin price, spot price, but the beta isn't high enough yet where we're seeing prices explode for ASICs. And I think that will happen. It's largely a function of like the supply side of the equation, which for the most part, there are still, plenty of machines available in the United States. So as demand chews through that supply, we expect to see, prices increase significantly. I think kind of what we saw historically is like that beta that I keep mentioning, right? If there's a, for broader context, if the beta is 1.0, that means for every 10% Bitcoin moves, rig prices would move 10%, right? Now I would say that beta is at maybe like, I don't know, 0.25. If Bitcoin's up 40% in the last, month, rig prices have maybe gone up 10%. As the market kind of moves through into the later stages of this cycle, you start to see that beta increase exponentially until it's at 1 or even greater than 1, right? But there's this lagged effect. So it's kind of this complex supply demand dynamic, but it's certainly moving in that direction of rig prices are going to increase. And assuming this market's going to continue, at somewhat of the same trajectory that it's at right now, we're almost certainly going to see rig prices increase. And to Danny's point, that in my mind, rings the bell of there's an opportunity here. There's a window to get positioned where you have confirmation from the market that we're in this bull cycle and that Bitcoin price is more than likely going to top out at more than the 92 or 93K that it has so far. So with that, you would expect rig prices to increase, meaning on one side of the equation, it's a really good time to get positioned so that you're not spending more on hardware than you have to. And then also on the sell side of the equation, which is something that's really unique to this cycle, primarily because of the platform that we offer with the ability to access liquidity on your machines and resell hardware down the line. There's also that opportunity on that side of the equation too, where if you're buying a machine for $25 a T today and you think Bitcoin's going to go to, pick your crazy number, you can be relatively confident that you're going to be able to sell your machine down the line for more than $25 a T. On the resale side of things, you're effectively just lowering your cost basis by running your machines today at a positive carry, right? If you're making money each month, you're earning more Bitcoin than the amount of money you're spending on electricity, then that positive spread effectively lowers your cost basis until you get to resell your hardware. So it's kind of this perfect window, at least in my opinion, to be positioning into miners where rig prices haven't caught up to price action, but you can be, pretty confident that that's going to happen at some point.
That's a great way to frame it, Blake. Mining is long Bitcoin with a positive carry. So, even if we go sideways at 90K for another couple months, you're still arbitraging, you're mining at 40K while the Bitcoin price is 90K. And then if Bitcoin rips, you're going to see that beta rise for mining rigs. That makes a lot of sense. And you brought up a great point about the marketplace because this did not exist in 2021 during the last Bitcoin bull market. And it's finally like for once you have a real transparent way to have insights into the ASIC pricing market, right? Because historically, Bitcoin mining has been it's like a niche within a niche, right? And so a lot of the deals for miners are going on in Telegrams and Twitter DMs and these kind of backdoor channels. There was never really a platform where you could see, how much does the latest Bitcoin miner cost and have a really transparent free market way to do that the same way you can just, Google the Bitcoin price. So actually having a marketplace, I know I check it every day. I'm sure you guys do as well. And a lot of our listeners are always on there just seeing how the Bitcoin mining rig price market is shaking out. And so I'm really excited to just have that platform to easily buy and sell machines and then just get insights into the industry in a way we haven't really before. I want to wrap this up kind of talking about the public mining companies. What would you, because a common pushback I hear is, I could just buy the mining stocks instead. And it's usually coming from this position of feeling like it's difficult to compete with these public miners. So can you kind of dissect the advantages that an individual, hosted miner has over some of these public companies? And what are the trade-offs here versus, buying a public stock versus having a hosted mining rig with Blockware or another host?
Yeah, I can kick that one off, and I want to look at it kind of from a broader perspective that um, we're on this kick of like the modern portfolio, right? The modern Bitcoin portfolio. And again, this is not financial advice. This is the way I think about it. And there are a number of different assets, if you will, in the modern Bitcoin portfolio. There's Bitcoin. Then there's a variety of publicly traded Bitcoin proxies like MicroStrategy or other corporations that are publicly traded that have a Bitcoin treasury strategy, right? They're going to move at some sort of beta correlated to Bitcoin. Um, then you have miners, which are publicly traded Bitcoin mining companies, which have their own beta-based correlation to Bitcoin. And within the miner sector, there's a variety of different strategies. There's pure play Bitcoin mining, proprietary self mining organizations. There's companies that do some hosting and mining. There's diversified energy management strategies as well. You see a lot of energy selling take place. In the summers in deregulated markets like in Texas, for example, where a lot of publicly traded miners have operations. And then in that modern Bitcoin portfolio, there's also owning your own Bitcoin miners, right? And I think one thing that's important really to reiterate to our listeners is like what Blockware does is make it exceptionally straightforward for you to acquire Bitcoin mining rigs, which are hard assets that have a spot value. And to Blake's point with our marketplace, have spot liquidity on those assets. And they are creating incremental Bitcoin constantly that go into the Bitcoin treasury of your modern Bitcoin portfolio, right? So I do like to look at this kind of from an overarching perspective that I think, you know, this is a different type of diversification than, our grandfather's diversification, but this is like Bitcoin exposure diversification. And it would be doing yourself a disservice to not have direct exposure to Bitcoin mining rigs because it's very straightforward from acquisition to sale and then what the economics are as far as, generating incremental Bitcoin, arbitraging. Technically, you're arbitraging energy using Bitcoin as that arbitrage vehicle, but effectively, you're arbitraging Bitcoin price by constantly dollar cost averaging, across the board. Like, I'm sure you have some thoughts, and I didn't answer the question directly. I more so kind of set it up from like what do you think about the mining, stocks? I'll add one thing, and then I'll pass it to you. Is that um, Bitcoin mining, publicly traded companies, just like any publicly traded companies, are centralized entities with centralized strategies and objectives that are unique to what they're trying to accomplish. Right? I like to think that the mission is to be a good, fiduciary for their shareholders, right? But there's a lot of moving pieces there. I don't know what a Bitcoin mining company's strategy is going to be tomorrow. I don't know exactly what their operations are like. I don't know if they're gonna, pivot more to AI. I don't know if they're gonna sell all of their Bitcoin and get off of their HODL strategy, or if they're gonna go hit the, the classic ATM and dilute the shares to finance incremental growth. I don't know. I wake up and I see what happens, and it's like, okay, they did that, they did the other thing. I'm trusting that the leadership in these organizations are making, sound, forward-looking decisions. When you're mining, and there's nothing wrong with that. It's just those are the facts of entering that sort of, investment. When I'm mining Bitcoin, yes, you are going to have a counterparty, so to speak, if you're doing it in a capital efficient way with Blockware, for example. But it is more predictable. I do control my destiny more so than I would making an investment into public market, equities. Blake, what are your thoughts, man?
Yeah, I don't have a ton to add beyond what you just said. I think to your point, in the modern portfolio, if you will, that seemingly, if you're listening to any financial institution, needs Bitcoin exposure from one means or another. I think that mining and owning pubcos can both have a piece of that portfolio and should have a piece of that portfolio. Speaking for myself, like, I own miners and I own shares of publicly traded companies that are also have the similar business model. I think a way that to frame it that could make sense for the more traditional investor is like, buying machines itself is like going out and buying a piece of real estate, like whatever, buying multifamily real estate, and you have a cost each month to whatever, finance your property or keep your property running, and then you have income from tenants, right? That's one avenue you can take to earn cash flow. The other one would be like, you can go in your Roth IRA and buy like a REIT or something, right? That's a very similar, at least in the way I look at it, to I can go out and buy machines that I can put on my balance sheet and depreciate on my taxes and whatnot, not financial advice. And I can also go out and buy, shares of Riot and Marathon and CleanSpark or whatever. So it's kind of just different avenues that you can take to expose yourself to the mining sector as a whole. Now, I personally allocate more capital towards buying machines than I do buying shares of publicly traded miners, because I think there's a ton of benefits that owning publicly traded companies just can't give you, right? To Danny's point, like, you don't have you control your own destiny, like on a treasury point of view, right? You can, some of my clients, like, they earn whatever, they earn $1,000 a month in profit, and then they take that $1,000 and they go and deploy it into altcoins, or they go and put that into Bitcoin ETF with different tax advantages depending on the account it's in, whatever. There's all kinds of different strategies that you can take there, but in the end, you control your own destiny. You're not reliant on a management team and a board to make decisions for you. And to that point, you don't have the overhead that a publicly traded company does, right? You're not, you own the machines itself. You don't own the infrastructure if you're working with a hosting company like Blockware. So you don't have to deal with all the overhead that a publicly traded miner does. Like, look at the earnings per share on a lot of these companies. For the most part, it's negative, right? Because yes, you're earning a positive carry on mining Bitcoin, but you have so many other expenses that it nets out to be to a negative for them. So you're earning a positive cash flow and you don't have the overhead. You're not paying the salaries of executives and the operations team that runs your machines, et cetera. And it's also Bitcoin denominated earnings versus US dollar earnings in a, investment account. So to kind of wrap it up and to reiterate what Danny was saying, I think there's a place for both of these things in the modern portfolio, but some of them have, mining itself has different benefits that owning shares of a publicly traded company does, and owning shares of a publicly traded company can have, different benefits that maybe mining doesn't. So I think it's kind of dependent on the individual investor and kind of what their goals are and what their outlook is like. But for me personally, I find that owning the machines itself has been a far better trade for me than owning shares of these companies.
Yeah, Blake, I let me just add something there. I look at it in a similar way, and I'm trying to figure out like how I would qualify that. I think there's two vectors that are important. One is on a relative certainty basis. If you control, I am buying these mining rigs. Here's, I can't. There's no crystal ball. I don't know what the price of Bitcoin or what difficulty is going to be tomorrow. But neither do publicly traded Bitcoin mining companies, so that's a constant. I have more certainty in the future decisions made in the context of that investment because I control my destiny. If I want to sell my rigs, that's my decision. If I want to, take some money out and put it into something else or buy Bitcoin, well, I'm creating Bitcoin, buy something else, I control that decision. So personally for me, I would rather be certain than uncertain, and it's a relative scale. So there's trade offs there. The other part of it is that you brought up a good point with the negative earnings per share because of overhead and salaries and all the stuff that goes into making investments in those public entities. The operating economics are better if you just buy Bitcoin mining rigs, you know, generally speaking, right? Because there are less costs associated with that. So those are like and again, this is my personal opinion and how I personally manage my own capital with diversification across, companies like literally MicroStrategy, publicly traded Bitcoin mining stocks, primarily ones that I have a lot of conviction in the management teams because that's where a lot of that risk comes from. And when they have very clear strategies that have a lot of run rate towards them, right? And then I mine Bitcoin. I own Bitcoin miners. What I don't do, generally speaking, is buy much Bitcoin because I'd rather just mine Bitcoin at a significant discount to the price in which I could otherwise buy Bitcoin. Mining has enabled me to eliminate that. It sounds like crazy, like I'm eliminating dollar cost averaging. No, I'm constantly dollar cost averaging, but at a significant discount to the price at which I could otherwise dollar cost average. Right.
Right.
So, anyways, a little more perspective there that hopefully is helpful.
Yeah, I think you guys shed a lot of light on that. To kind of summarize, when you buy miners, you get to be your own mining company, right? You get to make the decisions, you're in charge, and you're accumulating Bitcoin the entire time, right? You're literally getting Bitcoin in your cold storage wallet every single day versus, you buy these mining stocks that as they try to scale their business, it brings on all this additional cost just to run the business, employees, new infrastructure, management, compensation, all that sort of stuff. Versus if you're a hosted miner, all you do, you just buy the machines and you pay for the electricity. That's it. You don't have all this additional overhead constantly getting Bitcoin into your cold storage. So appreciate you guys coming on. Where can we send the audience to, get in contact with you guys and learn more about mining with Blockware?
Yeah, you can find me on Twitter. My handle's Blake Davis 50. You're more than welcome to reach out to me personally via email. My email is blake@blockwaresolutions.com. You can always hit up sales@blockwaresolutions.com. I'm always happy to hop on a call and discuss all things mining and answer questions and jam about any of these topics we just discussed. So feel free to find me there.
Yeah, and I'm on Twitter, Danny Condon 1989. Danny@blockwaresolutions.com is the email. It's actually probably a better way to get in touch. And then to Blake's point, sales@blockwaresolutions.com. If you want to learn about Bitcoin mining, you want to get some Bitcoin mining rigs, that's a great way to get in touch. And appreciate you having us on, Mitch.
Appreciate it, guys. See you.
Cheers. Take care.